Thank you, Jeanette. And yes, actually, I'm in Phoenix, Arizona, but it is still West Coast, so I have 6 in the morning here. Good morning, everybody. Thank you for coming. I'm happy to be here today with TradeThirsty. Today, we're going to talk about an option basic, something that I think a lot of people could apply to their trading. If you already are very familiar with options, part of this is going to be rehash for you. We're going to go over options in general and talk about what they are, but then we're going to get to a very specific part of options, and we'll talk more about that in a minute. My name, as we said, is Chris Mercer, and I'm going to talk about my company just briefly, and then we'll get into the presentation. TradeSight is my company. We have 3 analysts at the company. We've been around since 2001. We do market education in stocks, options, futures, and forex. We've trained over 1,500 people now on how to trade whichever asset class they're interested in. I was the founder of the company. A little bit of background on me. I got into the financial industry back in 1992, coming out of college in San Diego. I immediately got a job at a broker-dealer. I actually worked on a market-making trade desk when I was just coming out of college, and I moved to Denver to run the main trade desk of that firm for a few years. And at the same time, I was very active in taking courses about technical trading. I did a lot with William O'Neill, who's the founder of Investors Business Daily. We'd go to his seminars and learn about technical stock trading. I was trained in the CAN-SLIM approach, for those who are familiar with that. And I had a lot of brokers working at my firm who were very technical traders, so I learned a lot from them as they managed money throughout the 90s. I went on to start my own firm with a couple of friends here in Phoenix in 1995. And I ran the trade desk there. I also started managing my own client money. I was managing about $18 million by the late 90s, and then went on and sold the firm and moved away from the retail side of the business and founded TradeSight.com, as I said, in 2001. My other analysts at the company, Rich Derrick, is our head equity analyst. Rich's background is a little different than mine. He came up on Wall Street. He worked for a billion-dollar hedge fund on the buy-side desk. He has a very, very solid understanding of institutional trading. So whereas I'm sort of a technical background type of trader, I do some fundamental work as well. Rich is very institutionally organized, and what that means is he has a good understanding of how the big money players are behaving and acting in the market. So he does a lot of unique stuff for us. Mark Lykos is our head futures and forex analyst. Mark is a little bit older than I am. He started out in the late 80s trading bonds and oil, and did some special calculations way back in the day. You used to be able to go down on the floor of the CME, and you'd find sheets of paper that said the Lykos levels, and he created these support and resistance levels for futures contracts that people would carry around and use during the day, the floor traders themselves. And, of course, it doesn't work like that anymore, but that's where his background started, and he came on board with us and has helped us shape our futures and forex trading systems. And the 3 of us work together. We don't all have the same backgrounds, like I said, but we've kind of learned to work each of our specialties into one big system, and it works well for everybody, and that's basically what we do. So that's enough about me. Let's get to the actual presentation today. Now, when I do a short, 45-minute, 1-hour presentation, it's always hard to pick a topic. You can either pick one trade type you're going to teach somebody or something broad about the market. And today what I thought I'd do is talk a little bit about options. Options are the type of thing that some people love them, some people are scared by them. I think what we want to walk you through today is why options don't have to be scary if you just have a basic understanding of what you're trying to do with an option and which ones are appropriate. Now, let me scare you first. 85% of options trades that are bought by retail traders, 85% of them end up losing money, okay? So that should scare you. What you don't need to be scared about is once you understand which ones don't lose 85% of the time, then options are not as scary. So what we're going to do today is walk you through the basics of options. We're going to kind of blast through that in maybe 15 minutes or so. So if you already know exactly what options are, this isn't going to be new to you. And then we're going to start talking about the math. Now, when you teach a topic like this, I want to make clear, when I teach you a trade type or a trade setup, that's a trade management technique, how to get into a certain trade, how to manage that trade. This is more of a mathematical discussion. This is more of a money management scenario. We're going to talk about how to utilize a certain part of your portfolio properly so that you can actually lower your risk while still getting into a stock through the option that will give you the opportunity to make money in the same way without as much risk. So that's what we're going to do. Basically, an option is a derivative security whose value is linked to the price of a stock. There are two types of options, calls and puts, and we're going to go through this right now. So let's start with part one, options basics. A call option is the right to purchase shares of stock from the person who wrote the option at a specific price until a specific time. And we're going to break down what each of those points means because you have to define what an option contract is. A put option is the right to sell shares of a stock to the person who wrote the option at a specific price until a specific time. So we can play options two ways. The call options, when we buy them, allow us to benefit when a stock's going up, and a put allows us to benefit when a stock's going down, because one's allowing us to buy the stock and one's allowing us to sell the stock. Options are contracts, and each contract has several variables. Okay, there's the underlying stock symbol, there's the strike price, there's the expiration date, and there's the number of shares per contract. These are all the pieces of the contract that you buy when you trade an option. We're going to go through what each one of those is real quick here before we start to look at some examples of puts and calls. Okay, so let's talk first about the underlying stock symbol. This item is fairly straightforward. Options are based on the stock symbol that they are a derivative of. So, for example, if you're buying calls or puts on Apple, Apple is the underlying stock symbol. Remember, one thing to keep in mind about options, you don't just show up and trade options, okay? You have to actually know something about the stock that is the underlying stock of the option. So in other words, if I'm interested in Apple, if I'm interested in Google, if I'm interested in whatever stock, and I have a reason to believe that that stock is going to move from X to Y, then I can look at the options for that stock to try to benefit from the option price movement instead of the stock price movement. Because the stock, owning these stocks can be very expensive, right? Options can actually afford you ways to get into these trades with less money. Okay, but again, you have to have a reason to believe the stock itself is going to move. You don't just show up one day and say, hey, I'm going to buy some calls on Apple. Okay, you need to have a reason to believe that that's going to happen. The strike price, the term that you need to understand is strike price. This is the price level around which you are controlling the stock, and we'll show you some specific examples of all these things once we walk through the definition. So all stocks that trade options will have several strike prices available, usually spaced every $5, but sometimes at other smaller intervals. You'll see some examples today where the stock has a strike price every $1. Okay? So again, this is the price level around which we're going to control the stock. This is, for example, when we buy a call, we have the right to buy that stock at the strike price. That's why the strike price is very important. Okay? It's a piece of the contract. What price are you talking about when you're buying and selling these options? The point of an options contract is that it expires. This is what makes this different from a stock. Okay? You have the ability to control the stock, to sell it or to buy it, until the date of expiration. Currently, options expire every week. There are actually options contracts now that are weekly, although historically, prior to a couple years ago, options expired only on the third Friday of each month. So if I was talking about, let's say, the July contracts, guess what? Those expired yesterday. Friday, the third Friday of the month of July was yesterday. That's options expiration day. Okay? So typically when people talk about options, they talk about a contract that expires on the third Friday. The exchanges have gone on now in the world we live in to create some weekly options on certain stocks. But generally speaking, you're looking at people talking about the third Friday of the month. Most options are worth 100 shares of the underlying stock per options contract. So if I buy one call, I am controlling 100 shares of the stock. There are exceptions to this rule, like if a stock splits, then the number of shares that each contract is worth may shift. But generally speaking, any option that you buy will be used to control 100 shares of stock. So those are the components of an options contract. And now let's talk about how it's priced, and I'll show you on a screen what we call an options montage. An options montage is the display version of options. So when you look at a quote on a stock, you're going to do it a little differently with options. Options pricing is displayed typically in the format of this options montage with the call options on the left and the put options on the right. The strike prices, the prices that you're controlling the stock around, will be right down the middle, and then the options will be grouped by the expiration date. So let's take a look at an example. This is an options montage. This is for Apple again. And this is, at the time, Apple was sitting at about $145.60. Okay? And if you look right down the middle, that gray column, These were the July 2017. So these are the contracts that actually expired yesterday. They're no longer around. And then the strike price, the price level of which you're controlling Apple if you trade these options. Okay. On the left side is the list of the calls, and on the right side is the list of the puts. So, for example, if you go about halfway down on the left there, you're going to see the Apple 145, and I don't know if you guys can see my pointer or not, but if you can, the Apple 145 calls were $1.17 by $1.20. So 3-cent spread, difference between the bid and the ask on Apple. So that's a call. So when I buy the July 145 calls, what that means is if I buy one of them, I am controlling 100 shares of Apple at $145. I can buy that stock whenever I want until the option expires, if I want to, for $145. And I can just sell the option if I want to. I don't have to actually convert it into stock, but I have the right to. That's the point. That's what an options contract is. So the prices of the options will fluctuate up and down over the course of a day as the stock prices move up and down. That's the whole point of them. And what we're going to talk about today is, first of all, what are these different options pricing? What do they mean? What are the ones that you would look at more specifically for a less risky trade, not a more risky trade? We're going to talk about that too, but let's talk about a less risky trade than actually trading the stock. All right. So again, how is a call used? When you buy one call option, you are buying the right to purchase 100 shares of the underlying stock at that strike price. So the example I gave a minute ago, 145 on Apple, until the options expire. In this case, what I showed you a minute ago, they expired on Friday. Thus, generally speaking, if the underlying stock goes up, the value of the call will go up, right? And that's what's important here. So if I buy the right to buy Apple at $145 and then Apple goes up $10, the right to buy that stock at $145 is worth more by definition. It has to be. Okay? So that's why we get involved in options trading. When you buy a put option, you are buying the right to sell 100 shares of the underlying stock at the strike price until the option expires. Thus, generally speaking, if the underlying stock value goes down, the value of the put will go up. It's going to go up in value as the stock goes down because the right to sell it at a certain price goes up if the stock has dropped down from that price. Now, people use put options, for example, if you have owned Apple for years and you don't really want to sell it, but you're worried that the stock price might go down, you can buy a put option that will protect you, allow you to sell that stock if it really were to drop. At the same time, if the put option goes up in value, you can just sell the puts, lock in that extra money that you made, but keep the stock. So there's a lot of uses of options, and people do very complicated option strategies. We're not going to get into all that today. We do train on that type of stuff if people are interested. But it gets very complicated. You can blend the calls and puts together into making synthetic positions and all this other stuff. I'm not going to get into all that type of stuff today. All right, so how are options priced? There are generally two components to the cost of an option. There's the inherent value and there's the time premium, okay? And this is it. I mean, there's really nothing else to it. Your option pricing is going to include both of them, and it's pretty easy to calculate which is which. So let's do that right now. The inherent value of an option is the exact pure value that it is actually worth in real terms. For example, a call option with a $15 strike price, when the stock is currently trading at $18, has an inherent value of $3, right? Because it has to be worth at least $3 when it's at 18, if I can buy it at 15, right? I can go grab this stock from somebody at $15 when it's at 18. I can sell it right now. Boom, I just made $3, right? So there has to be at least a value of $3. That's the inherent value of the call option. Time premium is any extra value given to the option based on the following factors: the likelihood of the price to move and the time left until expiration of the option. So in other words, just taking that last example, a 15 call when the stock is at 18 is worth at least $3. That's the inherent value. But it's going to cost you more than that. And how much more is about how long until that option expires. If I'm looking at the options that are expiring this month, there's probably not a lot of extra time value. But I can look at options that expire next year if I want to. And that gives me a lot of extra time to own that stock or control that stock around the strike price. but because I have a full year to do it, I'm going to have to pay an extra premium to be able to control it for that long. So the cost of those types of options goes up, and we're going to show some examples. All right, so that is the quickest, fastest primer on options I can give. I do it that way because I know some people don't know anything about options. Hopefully you were able to glom onto what a lot of that means. At the same time, people that are already familiar with options, I don't want to burn our time walking you through the basics. So that is the quickest primer I can give on how options work. Let's take a look at some options values, and then we'll start talking about how it can be factored into your trading. All right, so an example of a call. Let's say stock XYZ is trading at $24. Okay, a call option with a strike price of $20 expiring in October, so a couple months out from now, costs $6.50 as an example. That means it has $4 of inherent value, right, from $20 at the strike price up to $24 where the stock currently is trading. There's $4 of real value right there. And then $2.50 of time premium, right, that extra amount, because they must believe this stock can move, and because you're talking about 3 or 4 months out before this contract expires, you're going to pay the extra $2.50 if you want to own this particular option on this stock. Okay, that's an example of that valuation. Now let's do a put example. Okay, let's say stock ABC is trading at $33. A put option with a strike price of $35, so a higher price that I can sell the stock if I want to, expiring in August. It costs $3.20. So what does that mean? That means it has $2 of inherent value from 35 down to 33. Remember, we can sell it at 35, but it's already at 33. So that ability to sell at 35 has $2 of value. It's already the ability to sell it 2 points higher than it already is. And then an extra $1.20 of time premium, right? That's the extra, a little bit of extra value because there's a month or so until this option expires, and then based on how volatile the stock is, the likelihood that it's going to move up and down, that's what I pay $3.20 for that particular put option. Now, both of those examples, there was an inherent value and there was a time premium value. Let me give you one other case scenario here for options. And remember when I talked about 85% of options expiring worthless? All right. Out of the money examples, let's say stock LMN is trading at $8. A call option with a strike price of $10 expiring in September may cost 70 cents. Okay? That means it has an inherent value of 0. Think about that. The stock's at $8. We're buying the right to buy the stock at $10. That's not worth anything by definition, because right now the stock's lower than that. You can buy the stock cheaper than that. Okay? That means that the entire 70 cents that we're paying is premium. Okay? It's still a lot cheaper than buying the stock itself, 70 cents instead of $8. But for that thing to actually have value when it expires in September, it's going to need to get moving and get above $10 by a bit, right? So that's what we call an out-of-the-money option. You're paying, everything that you're paying is time premium. There's no actual inherent value to the option itself. All right. So let's talk a bit about in-the-money options trading, which is the focus of what we're doing today. And we're going to do some examples and charting and all this other stuff too. When we say that an option is in the money, it means that the current stock price is above the strike price of the option for calls or below the strike price of the option for puts. What this really indicates is that part of the value of the option is real and not just time premium. So there's actual value to what you're buying. And one of the things I always tell people in life when we're trading, pretty simple, if you're looking to make money at the end of the day, there has to be value to what you do. I mean, when you're buying options that have no value to begin with, you're really gambling. Okay, and that's why about 85% of those options expire. The stock never moves enough to get into the money and make you up the time premium that you have paid on those options. So when I hear people go, ooh, I bought a cheap option on a stock, and I think the stock's going to go up, that doesn't usually work out. Matter of fact, I can tell you a handful of times that it does for people, and that's that 15%, right? And the rest of the time it's like, okay, well, good luck with that. Have a good day. In the money, the more in the money an option is, the more real value it will have. Okay? That means that as the price of the stock moves further in that direction, the price of the option will move more and more in sync with the stock price. Okay? Think about that, and then we're going to show some examples. The more in the money value you have in an option, which means the less time premium you're paying, the more real value you're buying when you buy that option. you are getting an option that is more and more in sync with the actual stock price. What does in sync mean? Talking about if a stock goes up $5, the option might go up almost as much as $5. Okay, that's in sync. When you buy an option that is out of the money, as the stock moves up $1 or $2 or $3, the option's barely moving. It might tack on 10, 20, 30 cents. Okay, it's not in sync with the movement of the stock. All right, so here's an example. MyGen, the stock symbol MyGen, M-Y-G-N, currently trading at $24.70. This was a screenshot from this week. Okay, I just took a screenshot of some calls. This is just the calls, not the puts on MyGen. Okay, so you can see down the right side there, the July, the ones that expired on Friday, the strike prices, 20, 21, 22, 23, 24, 25. Okay, and the stock was trading at the time at $24.70. Let's start at the bottom. Let's look at the 25 strike price. Okay, the bid is 25 cents, the ask is 40 cents. So let's just call it 30, 35 cents of value right there, right down the middle of the spread. Okay, what's that really worth? Well, nothing. The stock's below $25, so the right to buy the stock at $25 wouldn't really be worth anything, right? Who would do that right now? And so you're paying pure time premium. And remember, this is just from this last week. These options expired on Friday, so you only had a few days left. Think about that. You have a few days left. You're going to pay 30 cents. This stock needs to get over $25.30 just for you to get back to where you're actually in the value that you paid for the option has come back to you by Friday. See, that's why it's just wasted money usually. It's got to really expect that stock to get moving to even just get back to break even. Now let's look at the lineup, the 24s. Okay, the 24 options at the time were 80 cents by $1.05. So down the middle of that, about 90 cents, 95 cents in the middle. Okay, now think about that. 24 strike price, the stock's at $24.70. So right there is 70 cents of real value, right? And then call it about 90 cents worth is what we're going to pay for the thing in there. 90 cents, that's another 20 cents of time premium. Not much time premium for only being a point, not even a point in the money, but why? Because these options were expiring this week. The time premium's already worked its way out of most of them. Okay. Now, let's look at the 23, one line up, and what you see is $1.65 by 2.4. Yeah, it's a bit of a big spread. They don't usually have spreads that wide. But even there, what you're starting to see is as we get more and more in the money, if you add $23 the strike price to, let's say, $1.80, $1.90, right? Now you're looking at closer and closer to that $24.70, a little bit above that, $24.90, okay, of actual price that you're paying to control the stock. And if we just jump to the top line, look what happens. The strike price of 20, okay, look at that. $4.60 on the bid, $5, so call it down the middle, $4.80. Take 20, add $4.80, there's $24.80. You're exactly, the value is exactly what the stock is worth. Okay, so you aren't really paying any time premium, and you shouldn't be because these expire on Friday. That's how an options montage works. Okay, so the more and more in the money you get, the less time premium you're going to be paying on the option. And that matters. It matters a lot if you want to do this, because one of the things I say to people is, look, I work with people who are day traders. I work with people who are holding stocks for months. Okay, everything we teach people about the stock market converts to whatever time frame they want to look at. Okay, and if you are going to hold a stock overnight, in my opinion, there is an option that allows you to do it that will get you all the same upside of owning the stock, but with much less risk, much less money on the table if you just know how to do the options properly. And that's a very useful thing because, news comes out, stocks gap around, you're holding the stock, you've held it for 3 weeks, it's moved up, suddenly bad things happen, right? Who knows? I mean, you can lose a lot of money holding stocks if bad news comes out. When you use an option, you can still gain the same amount that you would have gained on the stock if you buy the right option, but you can only lose what you put into the option, and it's going to be considerably less than what you put into the stock itself. And we'll go through all the math. Like I said, this is a mathematical conversation today more than it is a technical trading conversation. But you'll see as we get into it. All right, so again, from that last one, from that last example with MyGen, if MyGen moved from $24.70 to $27, you would likely see the following options price movement. Of the examples I had on the last slide, I'm just picking 3 of them. The 25 call would move from 35 cents to $2.20. Okay, now let's think about that. What does that really mean when you in your account? Okay, let's say you bought 10 calls, which would give you control of 1,000 shares of stock. Okay, 10 calls, if we bought them at 35 cents, would have cost us $350. And then the stock moves up to 27, and it's worth about $2.20, and we can sell it for $2,200. Ooh, that's a big percentage gain. That's 7 times your money almost, at least 6 times your money, right? Going from 35 cents to $2.20. So you put up, for 10 of them, you put up $350, and you would have made $2,200. Sounds great, but again, the stock had to move from $24.70 to $27 for this to happen. So before you get super excited about that, let's just focus on what the stock had to actually do. The next line down, 23 call, on the last page, it was $2.10. It would move from $2.10 to $4.10 in that price move of the stock. So, well, if you wanted to buy 10 of them again and control 1,000 shares of stock, remember, each contract is 100, so 10 of them, 1,000 shares of stock, would have cost you $2,100. Stock moves up $2.30, and you get $4,100 out of it. On a percentage basis, certainly not as interesting as that top line, but remember, it's that top line that was out of the money. 85% of those are losing trades. So it's great when it works, but most of the time it doesn't work, right? And then the 20 call, if you've been even more in the money, would move from $4.80 to $7.10. So again, $4,800 for about 10 of them. It's to $7,100 in the end, okay? Which of these makes the most sense? That is the point of being here today, is we're going to talk about if you had a certain type of stock set up, you thought the stock was going to make a certain move, what is the option that makes the most sense? So let's discuss the difference there. That 25 call, like I said, moving from 35 to 220, it's a big move, right? The flip side, the one at the bottom, the 20 call that moves from 480 to 710, doesn't look like it's as big of a move, Percentage-wise, it certainly isn't. But again, like I said, that first one is a very high-risk play. And remember, on top of it, that 35 cents you paid, remember, we only had a week. That stock would have had to move. I'm just showing you the math of what you would have got if it had moved, but remember that it actually has to do that. So it had less than a week before expiration for that stock to go from $24.70 to $27 just to make that happen. So it looks like a good gain on the option percentage-wise, but you really had to have this big move in the stock in a very short period of time for that to actually play out. Okay? But now let's discuss the money side of this. Okay? The difference between owning 1,000 shares of MyGen, if you liked owning the stock, and owning 10 of the 20 strike price calls. Okay? So if I want to buy 1,000 shares of MyGen, right, at that price, it was $24.70, right? That's $24,700 I've got to use in my account. Now, you can say, well, maybe I have a margin account, so really I only need about half of that. But keep in mind, bad news comes out on MyGen, the stock drops to $5 overnight. Okay, it doesn't matter if you had margin or not, you were on the hook for $24,700. The stock drops to $5, and you just lost, $19,000. Okay, so keep that in mind. Whereas if I bought 10 of the 20 strike price calls, that cost me $4,800. Right? So again, in a margin account, the first one requires half of the $24,700, still requires at least $12,350. Even if nothing goes wrong and the stock just does its thing, doesn't gap down on you, you're still having to put that up and then borrow and then pay the interest to borrow them on margin. Or you put the whole cash up, $24,700. Okay? But I've also got this option opportunity. I could have used the 20 strike price calls for $4,800, 10 of them. What is the upside-downside difference in what I make if the stock moves? This is what matters, right? And now I'm going to give you an example because we're going to look at it. There's OMER. Okay, so one of the things we teach people to look for, if you look at this charting, but this is a daily chart of OMER. All right, and you can see the nice sideways basing action. We teach a lot of technical charting patterns and stuff like this in our system for stocks. And what I like about this one is it's been consolidating. Look at the last time this one made a move back in March on the stock. If you look at the key across the bottom, it had like a sideways cut, and then it broke out on some volume, and it made a good move. And then it has held that move. And now it's basing what we call consolidating, going sideways, but it made this big candle again, similar to what it did back at the end of March, and look at the volume starting to pick up again. So this was one of our stock picks for our subscribers on the day that it's listed here. This is before it actually triggered. So we told people to buy it if it goes above this price. Now, you can just trade the stock. That's fine, fair enough, not a problem. But when you look at a pattern like this and you think, hey, man, this thing's got potential for a couple of days, a week, a month, I don't know. I think it's going to make a move. Do you really want to go and buy the stock itself? Or do you want to look at the options? If I'm going to hold this stock overnight, do I just want to buy the stock and take a risk every single night coming in if I'm going to hold it for a week or 2 weeks that potentially something goes wrong in the stock? So there's options on this stock at a strike price of every point. So in other words, just like the MyGen, there's one at 17, 16, 15, 14, 13. Every single point has a strike price. And remember, this stock was $17.10 or so that we were looking at the breakout price. So with 1 week left in the June contracts, okay, again, how long you got to think? How long do I want to own this? This looks like a pattern to me that could make a move, not just for a day or two or three, but maybe more than that. I want to own this for a while. It's going to go to hopefully the next level. Okay, so instead of just looking at the June contracts, because this was in June at the time of this trade, instead of just looking at the June contracts, we jump ahead 1 month and look at the July contract. So now we've got 5 or 6 weeks that we can control this stock through the options, right? And here you go. This is about using the midpoint between the bid and the ask, just for simplicity. This is the examples. Remember, the stock's about $17.10 or so. That's where we were at. Okay, so the July 17 calls were 95 cents. Well, that's almost all time premium. There's no actual value in that when the stock's around $17. July 16 calls, $1.70. Okay, well, the stock's worth $17, so that's at least $1 of real value, but still 70 cents of time premium. Look at the 15 calls, $2.45. Okay, well, we're getting better here in terms of taking down that time premium. There's $2 in value there between 15 and 17 and only 45 cents of time premium. One more down, I go to the July 14 calls, right? It's $3.30. Okay, now you're talking, right? Because now we're down to the point where that stock was at $17.10. Now you're talking about $2 and a little bit more of actual value, and then just 20 cents of time premium. That's it. That's the one I like. I've gotten the time premium down so low that it doesn't really matter. And if I go one more down, the only thing I gain is 5 more cents of actual getting rid of time premium. So that's not that interesting to me. Okay? So it's the July 14 calls that I would be interested in on this stock. So at the time that it breaks out through that old high level, we're going to buy the option if we want to be in the stock for a couple of days. You can also just buy the stock if you want to day trade it or whatever you want to do. Okay, there's a lot of different opportunities, but you got to recognize where these patterns can take a stock. So here's where this stock went, right, over the next 2 weeks. Okay, and again, how much of this you want to hold, how you get out of the trade, that's the trade management. We're talking about money management today, not trade management. Okay, so how we get our final exits and all that stuff. And remember, if you bought 10 calls, you can sell half of them. You can do all sorts of things. You don't have to just sell the whole block. So you can sell pieces along the way as they get more and more in the money. But, this is what the stock did. I mean, it went as high as almost $27. Okay, and I'm not saying anybody would have exactly sold at the top, of course, $27. But somewhere between $17 and $27, stock made a decent move. That volume was picking up. We saw it. Boom, we got that breakout, and that breakout carried through, just like it carried through the first time in March. And if you go back, it actually did it in February, right? So this stock has a pattern of moving. It's a growth stock. Okay, let's go back to the option conversation. So at $17.20 or so, that was the breakout. 1,000 shares of OMER would have required $17,200. And let's just say you sold it at 25. Doesn't really matter. I'm not trying to talk about trade management here. I'm just doing the mathematical part of this conversation. If you sold it at 25, you made $7,800. Okay, so you put up $17,200. You had the risk every single night in case something went wrong on the stock, and you made $7,800. Meanwhile, if you bought 10 of those July 14 calls, it would have cost you $3,300. Remember, they were $3.30. And if you sold it when the stock got up to 25, you sold those calls, you would have made about $7,700. You see the difference? The most I could have lost, if this stock went to zero overnight, bad news, the whole company's a fraud, something like that, right? I mean, it could happen, right? I've seen it. Probably not, but I've seen it, okay? If this stock goes to zero overnight, If I own 1,000 shares of the stock, I would have lost $17,200. But if I owned the option, those 10 calls, I still control 1,000 shares of the stock, I only would have lost $3,300. But the move it made, whether I own the stock or the option, because I bought the correct in-the-money option, I didn't pay a lot of time premium. I didn't waste my money on time premium, right? I made almost dollar for dollar what I would have made owning the stock. Think about that carefully and then ask yourself, when you go, oh, you see a stock and you go, I think this stock's going to move over the next month or two. Think about that carefully and ask yourself, why would you buy the stock? It's a really important thing to consider. And I know that, for some people, options, great, they're good with them. For other people, options sound scary. We don't want to deal with options. But I'm just telling you, when you're deciding to carry a stock overnight, from a money management perspective, it's very important to at least take a look at those options. It can lower your risk considerably while still giving you all the upside. Don't play these out-of-the-money options, not for stuff like this. But there are ways to play an in-the-money option that gets you the same upside. Here's an example just from this week. Okay, this was one of our top picks, NTRI. Again, look at this pattern. Like a nice sideways. The stock had gapped up back in March on some positive news. It has held that gap. It has gone sideways for 5 months or so. It is turning up. The volume is picking up. Okay, same type of stuff that we like to look for in a stock. And you can day trade it if you want. And the day it breaks out is going to be a key day. You can get involved each day in just trying to find entry and exit points if that's your thing. But if you're into holding the stock, this is what we send to our subscribers. So this was our top pick back on, I think, Tuesday, was to buy the breakout over $57.50. That was the new high breakout on NTRI, okay, at the time. And if you look at this, we're only 3 days into the trade now. But again, starting to work, made its initial move. It's about 2 points in the money already. Okay, we're only 3 days in. Nice pattern. This thing's got a lot of potential. It's a $50 stock, though. Own 1,000 shares of a $50 stock or whatever you can afford in your account. 1,000 shares would have cost you $56,000 plus bucks or $57,000. Right? There was an option, I promise you. There was an option for $5,000, maybe $6,000 that was in the money with very little time premium that you can be in this thing and not be putting up. Now, the only thing I will warn you, this is where people go overboard on this stuff. You have to look at it as allocating your funds in your account, right? So if I would have been willing to do 1,000 shares of stock, which would have cost me $50-something, and I can find an option, I'm still just going to do 10 of the calls. There's some people go, oh, cool. Well, if I don't have to use all this money, I can buy 100 calls. And, and now they're locking down like 10,000 shares of the stock because that cost them $56,000. No, you should do the option for the same amount of size, number of contracts that controls the amount of shares you would have bought. That's how you use this as a money management. Now you're just not using all that money. Okay? Hope that makes sense. So that's a little bit about in-the-money options, and hopefully take some of the scare factor out of options for some of you. And if you have trade options, maybe that was at least something to think about in terms of money management and applying these things into your accounts. We do have a couple special offers today through this TradeThirsty event, and these are exclusive to this event. As I said, we are an education company. We teach people how to trade. We are also a trade calling company. We have a stock service that gives stock picks on a daily basis. So let's go through what we do and what the offers are for you guys today here only at TradeThirsty. So our stock service is usually $297 a month. As I said, there are 3 analysts in the company. You get the daily stock picks, all the picks that we make from all 3 of our analysts. So anybody that has an idea for the day, and usually there are many, and they have, some of them are longer-term trades and some of them are shorter-term trades, but whatever we're looking at, you get everything that the analysts are considering and the entry points and everything that goes with that. You get real-time market commentary. We have a live trading lab. You can listen to all 3 of us talk about the markets all day. We talk about what we're doing. We show our charts on the screen. We will answer any questions you have, either about our trades that we've called, or if you've got questions, you want us to look at the stock of your own, that's what we do. We have daily market analysis reports that analyze the markets, talk about what's coming, talk about what's the general tone of the market, stuff like that. Our offer here today, usually $297 a month. There is a 3-month package for $497, so it's basically almost half off of 3 months. Give you time to get used to what we do. And like I said, we are very hands-on with the people that come into our room. So Any questions that you have about the markets and about what's going on at the time, we are happy to answer and discuss both the technicals. And like I said, you get 3 different backgrounds. So, you know, I'm going to give you my perception from the charting perspective. Rich is going to give you his perception from the charting perspective. But Rich also knows a lot about how those funds work and the buy-side piece of that. So you can learn a little bit more about how that works and how different market components work. If you have questions about futures and forex, you've got Mark as well. The second offer, though, and this is the one that we're known for, is our 6-month mentoring programs. It's usually $38.94. This is what we do. Everything in the stock service is included for 6 months. So you still get all of our trade calls. You get all of our live market commentary daily. There's live daily commentary. You get all of the reports. Everything that you would have got in the 3-month package, that's already in for 6 months. That's included in this price. But this is what we do. We train people. With it, you get about 25 hours of educational material. We don't just dump it on you. We don't just go, here's you know, there's a lot of education services. Oh, here's your DVD. Go watch this and good luck. No. What we do is we give you so many hours of it first, and it starts out with more basic stuff, obviously. We'll go through real quick here what is in it. But we start you out, and then we have unlimited mentoring sessions, and I'll talk about those as well. So you're going to come to me, and you're going to talk about what you've learned so far. You're going to convince me that you actually get what was in those first few hours of material before we move you on to the next stuff, because each layer builds and builds and builds on itself, on each other. And until you understand one piece, you shouldn't be moving on to the next piece. And we're going to be very hands-on with you in making sure that you get all that. And then we have what we call a weekly trade blotter review process, and this is the piece that usually helps people get very profitable. We'll talk about that in a minute. So the purpose of the TradeSide Mentorship Program is to teach you how to trade like a professional institutional trader. You will come out of the program with a complete knowledge of the markets and how to spot a variety of different trade setups and then manage those trades correctly. If you are somebody who just likes to hold stocks, you know, days at a time, that will work. We will teach you how to do that, because chart patterns and everything we're going to teach applies in any time frame. If you're an active day trader, no problem. We'll help you out with that too. It all comes down to learning about the markets, and I'm going to give you the dump list here in a minute of everything that we teach. But this is what we are known for. Okay. Today's trade example that we taught you is just one of many different trade types. So if you're interested in this option stuff, you can apply that to the trades that we'll give you. Whether you take the 3-month and you want to just take our calls, we will tell you which ones you can apply options to. If you want to do it through the program, then you're going to learn how to spot these trades yourself, and then also learn how to take this options idea if you want to apply it to multi-day trading. Okay, so it'll make you an expert on all this stuff. Here's the stuff we teach. Chart patterns. What types of chart patterns? What is chart construction? What are the best chart patterns? Okay, identifying chart patterns is the key to being a success in the market. Indicators. I mean, everybody knows what an indicator is. I will tell you this, I'm not heavy on indicators. I know people, you know, I used to do a lot of beta testing for eSignal and a program called AIQ back in the 90s and TradeStation. I've done a lot of work with these companies. I know indicators inside and out. Every time they had a new indicator, they would come to me and say, hey, can you beta test this and tell us what you think? I've seen people that have traded with like 30 indicators on their chart to the point where I can't even see the price of the stock anymore because they've got so many darn indicators on there. I'll teach you a lot of indicators, but we are not heavy in the use of indicators. I don't think that you can just put up a moving average and a stochastic and couple things like that, and suddenly that gives you the answers to how to make money in the markets, okay? It's important to know what indicators are. It's important to be able to look at them when you need to, but they are not the primary focus of trading. Trade management. We talked a little bit today about the difference between trade management and money management. Trade management is identifying when to get into a stock and how to manage the trade itself. Where do you sell some? Where do you sell all of it? Where's your stop loss? How do you do stuff like this? That's trade management. Money management is how much of my account should I be using in a stock? Is there an option trade that makes sense that I can use less money but still get all the upside risk? That's money management. Okay, we're going to teach that as well. Order entry. We teach you how to place different order types. A lot of people are already familiar with that type of stuff. We teach market internals, the VIX, the trend, the advanced decline ratio. This is important stuff in understanding what the market is doing and which direction it's going to go, whether you're looking at it intraday or even over time. Okay, you really have to understand, I mean, what's wrong right now with the markets? Everybody thinks, oh, new highs all the time. This is exciting. The problem is that the VIX is under 10. It's horrible. There's no intraday volatility at all, and that doesn't usually hold. And when it breaks, it's usually not to the upside for the stock market. Okay, so there's a lot of things you need to understand and when those turning points occur. Murray Math is a specific type of tool that you can use for trades on the daily charts, on the intraday charts, everything. Fibonacci systems. We love Fibonacci's. Fibonacci's are useful in identifying where stocks are going to move to, where they're going to run out of steam. Bar counting, exhaustion tools, one of my favorites. understanding where the market is exhausted and going to reverse. Reciprocal range trades, those are more of an intraday thing for people who like to short-term trade. Pivot series, another thing that's crucial in trading. Volume analysis, understanding how this is something Rich does, because it's all about where are those big funds, what are they doing? How are they in the basket of buying or selling a stock? And that affects, obviously, the stock price if they're the big players. Looking at the volume. How earnings and option cycles impact the markets. Okay? Different times of month, different weeks, different things are going on based on earnings and options. Like I said, Friday was options expiration. We told our people, options expiration Friday in July shouldn't amount to almost anything. The S&P closes down 0.38. Okay? I think that's the definition of not amounting to anything. That's what we knew coming in. Wasn't going to happen. Nothing was going to happen Friday, and it didn't. Top-down market directional analysis, another key piece, more for intraday traders. The intramarkets, how does oil, gas, and bonds affect what's going on in the stock market? Those are just pieces of what we teach in the 6-month program. We don't just dump it on you and say, have a good day. We give you the basics to start with, and then we work with you. The mentorship program includes unlimited one-on-one private mentoring sessions to get all of your questions answered. It also includes a weekly blotter review. What is this? Okay, so the mentoring sessions, first of all, you sit down, you schedule with me, and it is me, it's not just an assistant. You'll be working with me throughout the 6 months, and we'll sit down and say, okay, you just learned this module on this topic. What are your questions? And we'll go through it until you understand it. And then you're going to watch what we're doing in the lab and the stock calls that we're making, and you're going to sort of start to see how we're applying that piece of the system that we've taught you. And we're going to keep giving you new and new pieces and make sure that you master each of those before we move you on. This is why it takes 6 months. If you really want to become good at trading stocks, you don't just sit down and start trading and chasing things around. You have to get a broad understanding of how the markets work and then start to understand all the pieces and the chart patterns and everything else. It takes time. We have found a way to organize this that is very successful. And then the weekly blotter review. After you get to a certain point in the program where you have enough knowledge about how to pick certain types of entries, no matter what time frame you're on, you're going to send us a blotter every week. We'll give you the parameters. We'll give you an Excel spreadsheet, basically. What you do is you're going to send us, this was the stock symbol, I bought this many shares at this price, I sold, whatever. Everything that you did during the week with notes, lots of notes. We teach you how to take notes on this stuff. And then we go through and review it, and we say, hey, based on all these things we taught you, yeah, you did this right. Yes, you did this right. Oh, why did you do this? This isn't what we taught you. This isn't part of, this doesn't make sense. This wasn't a good decision. And we go through and help you learn from a technical perspective what you're doing right and what you're doing wrong, so that after a couple of months of that, trust me, and people, I'm pretty strict on it, so if I see people breaking rules that we've taught them over and over and over again, you have to come to me every week and say, yeah, I did that dumb thing again, and that's what makes you stop doing it, because you don't want to hear it from me when I keep telling you why you're doing this dumb thing over and over and over again. But we have ways to correct everything that you're doing wrong. We have little systems that we teach people that will prevent them from making the mistakes over and over and over again. So that's why the program works for people. We've been doing it for quite a while. Like I said, it's not short, but it does get you there in 6 months. Promise. Mentorship program, like I said, is typically $38.94, and I've never done this before. This is the most we've ever taken off the package. This is for TradeThirsty for our first event with them. You can buy it for $29.97, so about $900 off of the program package, and we will spend a lot of time with you over the next 6 months. You will be hearing my voice on a daily basis. I have one guy that says, I wake up in the morning and I hear you start talking about the markets, and then in the evenings I'm doing educational modules, and by the time I go to bed, all I hear is your voice in my head. That's how it works. That is our presentation, or my presentation for today. I hope that it was useful for some of you. Hopefully we will be hearing from some of you in the future here. And I don't know, Jeanette, I can't see a text thing. Is there? Oh, I do see a question. Got 40. I do.
Yeah, you should see the questions box.
Yeah. I see it now. Okay. Do you guys mentor forex? We do forex trading too. Yeah, we do stock futures and forex. That is, if anybody has any other questions, I don't know how to direct you into how to put them in there, but feel free to do so. We do have a couple minutes left, I think, right, Jeanette?
Yeah, we do. Okay, let's see. So you're not seeing the questions, it seems like, because I see a bunch of them.
No, I don't.
Let's do a couple housekeeping items here first. Let's put your links in the chat area for them. Okay, so your offer links are not on that slide, though. Okay, so what are the offer links again, so I can post it for them? For the subscription?
TradeThirsty.com/alert.
Oh, the baby's awake. He is. Must be hungry. Okay, and what's the other one? TradeThirsty.com.
TradeThirsty.com/teach.
For the mentorship.
Oh, you know what? I do see some questions now. You know what this box was? Hang on.
Yeah, it's always collapsed over there. You gotta pop it out.
Right. Got it. Well, that changes everything.
All right, so let's watch our clock here. You got about 7 minutes.
Okay.
Okay, I'm going to mute, and I'm right here if you need me.
Okay. So somebody asked, do you have, no, we don't have our own trading platform. You can use any, that's a good question. You can use any broker. You can use any trading platform. We use eSignal. We have reasons we use eSignal, but it doesn't matter. We're going to teach you stuff. You can use, whatever broker you use and whatever platform. Obviously, some of the tools we teach, your platform has to have them. We can talk about that during the program. But the majority, the 90% of what you're going to learn is not sensitive to which platform you're on. So somebody asked that question. Is the stock picks through SMS trailers? The stock picks are through a private Twitter feed, so you can then send it to your phone if you want, or you can get it on your desktop. People love the way we do this. We have to accept you into the Twitter feed for the stock service, and then you receive all this information. It's not just stock picks. You get market YouTube previews and stuff like that. All sent. You can send it to your computer. You can send it to your phone, whatever you want, tablet. The special rate after the first 3 months, well, here's the deal. It is not necessarily locked in, but we're going to talk with TradeThirsty about 3 months from now, maybe doing another event and maybe doing the exact same continuation special for you guys. If you like the service, if you find it useful, we can work from that. I don't typically offer that price for the 3 months because I do have to pay my analysts, and once you get to know Rich and Mark, you're going to understand that they're worth money. So it's 3 months at that price is for 3 analysts, and what they bring to the table is pretty cheap. But do you take weekly options of the S&P? I can show you how to teach the weekly options of the S&P. Rich does a lot of ETF stuff, so the spiders, and then you can do the options on some of that stuff. And then day trading, yes, we do that. Why not go long on in-the-money positions? Why not go long on in-the-money positions? Not sure what you mean by that. That's what we were teaching today, was using in-the-money options for your trades. Do you recommend short or long for trading? We do both. I'm not, like I said, I'm not particular about the market. I just like to make money. So if I see a setup, on the long side, great. If I see a setup on the short side, great. One of the things we teach you, though, is it's not just about the stock. You also have to know the broader sense what's going on in the market. So, we haven't spent a lot of time on the short side lately. But, yes, we will help you out with options within the confines of the program. Depending on what you want in options. When it comes to this type of option stuff, this, like I said, stocks and options go hand in hand. You can't just trade options. You have to understand stocks to trade options. But yes, if you prefer the option stuff, once you get in the program, then yes, we can help you out on which options to take when you're doing the stock trades, essentially. Can this all be done on a tablet? You can receive the calls. You can get in our trading lab on the tablet. Obviously, from a trading perspective, you got to look at charts and stuff. I haven't yet found a trading package that works ideally on a tablet that gets me the amount of information I like to see from a trade. I mean, I have 3 monitors for trading, so that's not going to fit on a tablet. How much after 6 months? So after 6 months, that's a good question too. So after 6 months, this is the way our mentorship program works. After 6 months, we expect that you're at a point that you have a good understanding. You can go off on your own. You're done with us if you don't want us, and you're good. You've got a good knowledge base of the market. If you want to stay with us after the 6 months because you like our picks and you just want continued support and you want to hear about our view of the markets, or maybe you just haven't all clicked yet. I mean, and we have people that have been paying subscribers for over 10 years, still with us. Okay. If you want to do that, then yes, the monthly rate drops to $247 a month for people that have gone through the program. And that still includes, if you've gone through the program, even after the 6 months, if you continue with us as a subscriber, that still includes the private one-on-one sessions if you need them. You probably won't need them as much by then, but if you need one, no problem. And it includes the trade blotter review if you want to continue to send trade blotters. And I have a guy going on 2 years now. He's been sending me a trade blotter for every week for almost 2 years. Yeah, what option strategies you trade? I don't want to get into. So there's advanced option stuff too, and that's just a whole different conversation. If you really want to get into your multi-day trading, there's a lot of things you can do with options, but that's a whole different conversation. If you want to reach out to me at some point in time, we can talk about just what you can do with that stuff. That's opening up a whole can of worms. It's not going to get answered here in one more minute. I read 95% of traders lose money. I don't know if it's 95, but I do think a lot of people lose money, but I think most people have no idea what they're doing, and they just jump in and get going, and that's what kills you, not knowing and understanding. I mean, I spent a lot of money myself back in the early 90s going to seminars and in-person events because there was no online stuff back then, and I paid $50,000, $60,000 back then to learn as much as I could about the markets, and I had on-the-job stuff because I was working at the brokerage firm at the time on the trade desk. So I had a lot of experience before I really started trading for myself, before I had enough money to really just be actively trading. And, of course, back then it was different anyways. In the 90s, the markets were different. So, what we've evolved after this, people that sit down and just start pushing buttons, I think, they do kind of tend to blow up. It's not that simple. Mentorship, yes, is over the phone. When you do the private sessions, it's over the phone. You do the online education yourself. You come into our lab and listen to us during the day. You get all of our picks, and then when you need a session, we talk over the phone or Skype, whatever. Do you think doing money in the market these days is long or short trading? I have markets going down. Well, with what we do, it doesn't matter. Okay, the way we approach the markets is we trade what is going on. So if the market starts to roll over, there's a couple of days, if you go back a month or so, there was a pretty hard down day in the markets, and we made some good money on that day too. So, you have to always be not just looking at the stocks you're interested in. This is where the mistakes are made, but you have to actually be paying attention to the technicals of the market. The euro-dollar question. Yeah, I mean, our approach to forex is very, very bankish. We use a lot of key banking levels in our forex trading, but that's, again, a whole different conversation that would take us off a tangent for quite a while. I'm happy to talk about stuff like that, but we're time limited here. So if anybody has any other questions, post them here. I think Jeanette already posted the links, hopefully, up, and then maybe you can click on them on the screen. That is it. I'd like to thank you for your time. I'd like to thank Jeanette for having me here. And
Sure.
And I'm going to go back to bed.
I'm so thankful that you got out of bed for us, though. I know it's early. We appreciate you.
No problem.
All right, I'm going to post your links again and put them up on this slide that I'm about to share, but I'm going to dismiss you now so that for whatever reason when you close yours out, it doesn't kick everybody out. I'd like to thank you for coming. Y'all give Chris Mercer a big round of applause. A great speaker for kicking off our July event, and he will be back, I'm sure.